Number 1. The first call. You have $4.2 million in stock vesting next quarter, and your tax attorney is explaining why you should never touch it. The call came in at 9:14 a.m. on a Tuesday, 3 weeks after your company's IPO lockup expired. You expected a conversation about capital gains brackets. Instead, he says the word collateral 7 times in 4 minutes. The math sounds backward at first. You own shares worth $4.2 million. The bank will loan you $3.1 million against those shares at 2.8% interest annually. You pay $86,800 in interest for the year. If you sold the shares outright, you'd pay $798,000 in federal and state capital gains taxes immediately, plus lose the future appreciation on that $798,000 you no longer have. Your attorney is not telling you this is smart. He's telling you this is what people with $4.2 million in stock do. The difference matters. You realize during the call that he's already sent the paperwork to the bank. They've pre-approved the line. Your shares became collateral the moment they vested, whether you understood that or not. Number 2, the liquidity position. 6 months later, you carry $11.7 million in securities-backed loans across 3 institutions. You did not decide to build this structure through careful planning. It accumulated through repetition of the same logic at increasing scale. The vacation house in Montecito came through a pledged asset line from Morgan Stanley at 2.4%. The diversification into the private equity fund required $2 million in committed capital, funded through a credit facility at Goldman at 3.1%. Your accountant, a woman named Marissa Chen, who works with 12 other clients in your approximate wealth bracket, explained during your Q2 review that you now have more liquidity available than at any point in your life, while owning more assets than ever before. She did not frame this as an achievement. She stated it as a condition. The interest payments total $287,400 annually. The appreciation on the unpledged portion of your portfolio last year was $1.9 million. You are extracting value without triggering recognition events. This phrase appears in 3 separate documents you signed. You remember it because of how clean it sounds, how completely it describes something that feels like it should have friction, but doesn't. Number 3, the recognition event. Your wealth manager uses the phrase tax drag the way a cardiologist uses the word blockage. It is the thing to be avoided, routed around, minimized through structural intervention. You are sitting in his office on the 43rd floor in Hudson Yards on a Thursday in March. He has a presentation queued. Slide 4 shows 2 columns. Left side, sell $5 million in appreciated stock, pay $950,000 in taxes, net $4.05 million, invest the proceeds. Right side, borrow $5 million against the stock at 3.2% interest, pay $160,000 annually, keep the original $5 million growing tax-deferred, maintain the step-up basis for your estate. He does not advocate for the second column. He shows you what happens over 10 years in both scenarios, assuming 7% average returns. The left column ends with $7.89 million. The right column ends with $9.47 million in stock value, plus the liquidity you have already spent or deployed, minus the $1.6 million in cumulative interest payments. You are $2.58 million wealthier by never having sold. The math is clean, until you ask what happens if the market drops 40%. He has a slide for that too. Margin calls, forced liquidation at the bottom, crystallized losses. He says this is why you maintain loan-to-value ratios below 50% and keep uncorrelated assets. You realize he is not warning you away from the strategy. He is explaining the risk parameters within which the strategy remains valid. Number 4, the refinancing cycle. 18 months pass. You now think in terms of cost of capital, the way you used to think in terms of affordability. The shift happened without announcement. Your attorney emails you rate sheets, the way someone else might send restaurant recommendations. SOFR plus 210 basis points at UBS for portfolio loans above $10 million. LIBOR plus 180 at Merrill if you move $8 million in managed assets to their platform. You are being recruited by credit facilities. The loans are loss leaders. The banks want your advisory fees, your deal flow, your eventual estate settlement business. A vice president named Trevor Kallman takes you to lunch at Gabriel Cruther. He does not mention interest rates until dessert. He talks about wealth transfer strategies, generation-skipping trusts, charitable remainder structures. The loan he is offering, $7.5 million at 2.7%, is the simplest product he has. He positions it as the foundation. Everything else builds on the assumption that you never sell appreciated assets during your lifetime. You maintain permanent access to liquidity, while your estate receives a step-up in basis at death, eliminating the embedded capital gains entirely. Your heirs inherit the assets at fair market value on the date of your death. The taxes never come due. Trevor does not frame this as a loophole. He describes it as the intended function of the tax code, written to preserve capital formation across generations. Number 5. The wealth transfer. You are 47. Your estate attorney is walking you through a structure that spans 3 generations. The grantor retained annuity trust holds $18 million in pre-IPO shares from your second company. The shares are valued for gift tax purposes at 83 cents per share. The company goes public 14 months later at $19.50 per share. The appreciation happens inside the trust, outside your taxable estate. Your attorney, a partner at Greenberg Glusker named Victor Eng, explains this without celebration. He is describing mechanical function. The borrowing strategy extends beyond your lifetime now. The trust itself can borrow against the appreciated shares. The loan proceeds can fund the annuity payments back to you. You are extracting value from assets you have legally separated yourself from, using debt structures that exist in the trust's name, not yours. Victor says the word dynasty twice. He means the trust can persist for 120 years in South Dakota, longer in Delaware. Your grandchildren, not yet born, will inherit assets that have compounded for decades without ever triggering a recognition event. The loans will be repaid or refinanced by whoever manages the trust in 2089. You try to imagine that person, that version of fiduciary responsibility. You cannot. Victor does not need you to. He needs you to sign the documents that make their existence possible. Number 6. The liquidity addiction. You cannot remember the last time you sold an asset to fund a purchase. The memory should be recent, but it is not accessible. Your portfolio is worth $54 million across public equities, private funds, real estate, and a managed future strategy you do not fully understand. Your outstanding loan balance is $19.3 million across 5 facilities with weighted average interest of 3.1%. The math still works. The interest is $598,300 annually. The portfolio generated $4.1 million in appreciation last year, though $940,000 of that exists only on paper inside the private funds and cannot be accessed without selling your limited partner stake at a discount. You have not paid capital gains taxes in 6 years. This is not evasion. This is structure. Your accountant files every form correctly. The interest expense is sometimes deductible, depending on how the loan proceeds were deployed. A calculus that requires a second spreadsheet she updates quarterly. You were having dinner with a friend from graduate school who sold his company for $31 million and took the cash. He paid $7.8 million in taxes immediately and invested the rest in index funds. He seems pleased with this. You do not tell him about the loan structures, not because they are secret, but because explaining them would require reframing everything he thinks he understands about wealth. He believes he is $23.2 million rich. You believe you are $54 million rich with temporary access to $19.3 million in liquidity that costs you 3.1% annually to maintain. Both statements are true. Only one assumes the assets continue appreciating forever. Number 7. The systemic position. You are meeting with a tax attorney who specializes in ultra-high net worth estate freezing techniques. Your net worth crossed $80 million sometime in the last 18 months. You are not precisely sure when because the private equity valuations lag and the real estate appraisals are subjective and the stock moves daily. The attorney, a man named Douglas Fair who worked at Treasury before private practice, is explaining why billionaires die with massive loan balances. It is not a failure to pay off debt. It is the optimal capital structure. The estate pays off the loans with a portion of the stepped-up assets, eliminating the embedded gains that would have been taxed if sold during life. The math is simple at scale. A billionaire dies with $500 million in loans outstanding against $2 billion in assets. The estate sells $500 million at the stepped-up basis, pays zero capital gains, uses the proceeds to settle the credit facilities. The heirs receive $1.5 billion in assets that have never been taxed, and now never will be. Douglas is not advocating for this strategy at your current scale. He is explaining the incentive gradient you are already on. Every dollar you borrow instead of sell is a dollar that benefits from the step-up if you die holding it. The system rewards permanent leverage. You ask what happens if you want to deleverage, pay off the loans, simplify. He does not say you should not. He recalculates your projected estate tax liability if you sold enough to eliminate the debt. The number is $11.4 million higher than if you maintain the loans until death. You are being financially penalized for reducing leverage. Douglas closes his folder. He says this is why his clients carry debt until the end. Not because they need the liquidity, because eliminating it is a recognized tax event they can avoid by simply waiting. Number 8. The inheritance structure. Your children are 9 and 12. You are establishing trusts that will give them access to liquidity without ownership, distributions without control, wealth without the step-up basis compression that comes from outright inheritance. The documents are 127 pages. Your estate attorney explains that the trusts can borrow against their own assets once the children are 25, maintaining the same debt-financed consumption model you have used, extended forward another generation. The trusts will never sell. They will distribute loan proceeds. Your children will live on borrowed money, collateralized by assets they do not legally own, managed by trustees who will replace you after your death, then replace themselves, according to succession protocols you are defining now. You are not building wealth for your children. You are building a structure that produces liquidity from appreciation, without ever converting appreciation into recognized income. The difference is technical and total. Your daughter wants to go to boarding school in Connecticut. The tuition is $68,000 annually. You will not pay this from income. You will take a distribution from your securities-backed line, which will increase your loan balance by $68,000 plus the prorated interest. The assets backing the loan will appreciate by an average of 7% if the historical returns hold, generating $4,760 in growth on the $68,000 you borrowed, minus the $2,108 in interest at 3.1%, netting $2,652 in theoretical gain on money you spent on high school. Your daughter does not know this. She knows her parents have money. The structure behind that sentence is invisible to her, as it was to you at 12. As it will remain until someone explains that wealth is not what you have, but what you can borrow against what you have without ever selling it. Number 9, the terminal logic. You are 53. Your loan balance is $31.7 million. Your assets are worth $140 million. You have not sold an appreciated security in 9 years. The interest payments are $982,700 annually, less than the quarterly appreciation on your portfolio in an average year. You no longer evaluate purchases by asking if you can afford them. You model whether the interest cost of borrowing to fund them is less than the opportunity cost of selling assets to fund them directly. The calculation is automatic now. A property in Aspen listed at $8.5 million becomes a question of whether you can borrow $6.8 million at 3.4% against your muni bond portfolio, which is yielding 4.1% tax-free, creating a positive carry of 0.7% on the leverage itself. You can. You do. Your wealth manager does not congratulate you on the purchase. He notes that your loan-to-value ratio across all facilities is now at 24%, well within policy limits. You have built a machine that converts unrealized gains into lived experience, without ever triggering the recognition event that would make the gains taxable. The machine runs on the assumption that you die before the assets decline permanently, that your heirs receive the step-up, that the loans get paid from the estate at basis, that the structure persists. You do not think about what happens if the assumptions fail. You think about the $140 million growing at 7%, becoming $274 million in 10 years, against which you can borrow another $68 million at prevailing rates, funding another decade of liquidity without sale. Your attorney is drafting documents for a new trust. Your accountant is modeling the estate tax under 3 different scenarios. Your wealth manager is sending you rate sheets from 4 banks. The machine continues. You are inside it now, oriented by its logic, unable to imagine stopping because stopping means selling, and selling means recognizing, and recognizing means taxes you have spent 9 years and $31.7 million in strategic borrowing to avoid. Somewhere below, someone is getting their first stock option grant. They think it is about the shares. You know it was always about what you can borrow against them without ever letting them go.